So hello and welcome to another video. Today I'm going to be talking about a field which has emerged within the last 10 years and it has evolved a lot in the last 3 to 4 years, especially with the AI revolution. All of these technologies building up so fast. Quantitative finance is something truly of the future, okay? And learning the basics, or at least having an introduction and a small amount of knowledge about this field, is quite important because it's going to be very relevant in the future. It's already quite relevant now, and going forward this is only going to increase. So why should you listen to me about this? Well, because World Quant, the biggest quant finance organization out there, recently held a competition, and in that competition I was third in my college. I racked up more than 10,000 points, became a gold contestant. I became a research consultant for them, and blah blah blah. Basically I know what I'm talking about. Okay, so without further ado, here we go. Quantitative finance or quant finance is basically a field in finance. It's a financial field, obviously there's finance in the name. But this field combines maths, statistics, computer science and finance. Okay, it's like a mixture of all these into one field. Okay, it's mostly about using data-driven techniques and analyzing the markets and stuff to make stock market decisions. Okay, financial market decisions, security decisions, whatever. Okay. In simple layman terms, it's the marriage between numbers and money. Okay, you need to know maths, you need to know finance. Okay, simple. Okay, now to understand quant finance, let's break the whole thing down into a few concepts. Okay, these concepts are quite important in the whole scheme of things. Okay, the first concept is modeling. Quant finance basically relies heavily on mathematical models because these models try to represent real world behavior, real world financial markets and stuff like that. So these models which you build basically help you understand how people behave in the market, how you can assess the current situations in the market, how certain trends happen and things like that. Okay. Now the second key concept is data analysis. Quant finance people have a lot of data with them. Okay, this data is both historical, like the last 10-15 years in the stock market, and also real-time data. So what's happening right now in the markets, what is happening across industries and things like that. What do they do with this data? They sit and analyze it. They find patterns, they find trends, they find relations, correlations and stuff like that. Because what tends to happen is history repeats itself. Okay, 2008 happened, 2020 happened, 2023 might happen, I don't know. So what the data helps them do is they analyze it, they find out the patterns, trends, and then if something like that happens today, they can figure out what's gonna happen a year later or 2 years later, depending on what happened back then. So they all rely on the hope that history repeats itself. They analyze the data and they try and predict the future. Okay. Now another crucial aspect, this is a quite important aspect of quant finance, which is risk management. Now whoever has traded in the stock market knows that there is risk. Okay, you might lose all of your money that you've put. Not all of it, but you get the point. Okay, so quant finance, if you are using quant finance, then you have a lot of money which you have invested, a lot of capital. Okay, because not your everyday normal Joe will use quant finance. Okay, this is only for large organizations or big HNIs and stuff like that. So if you're using quant finance, then you need to mitigate your risk, minimize the amount of losses that you can take. So using statistics and a lot of other mathematical models, quant finance algorithms use some techniques like value at risk, stress testing and other such stuff to identify how much loss you are at and how much you can try and mitigate that loss. Okay, this is quite important if you don't want to lose your money, and nobody wants to lose their money. Okay, now the last key concept about quant finance is algorithmic trading. What are algorithms? They're basically a bunch of instructions that you give to a particular machine or a computer or a system or a model. Okay, now what do these algorithms do? They're sort of if else if then statements. Okay, so they have a few parameters, like for example, at what price a particular stock closed yesterday, or the 200-day moving average of a stock and things like that. And they have a few if then statements. So if the price goes below XYZ, then buy. If it goes above this, then sell. Things like that. These algorithms basically execute trades within seconds, because that's the whole advantage of quant finance. So when a particular market thing in 1 second goes up by 10 rupees, then this is immediately going to execute, immediately going to sell. And if it goes down 10 rupees, then it's immediately again going to sell, so that you don't lose more and stuff like that. So that's the big advantage that algorithms have over everything else. Okay. Now, all in all, quant finance has basically revolutionized this financial industry because hedge funds, insurance companies, high net worth individuals, and basically people who are who have a lot of wealth to take care of, a lot of capital. They use this instead of like relying on stockbrokers and humans, because algorithms are more accurate, they are faster, and they have like lesser problems to take care of. Okay. And quant finance has also paved the way for a lot of things, because quant finance needs unsupervised machine learning, it needs mathematical models, data science, data analysis, and a lot of other stuff which helps other people build such models. Okay. So for example, if you're a data scientist, you can also get into quant by building some models which help you make money. Okay. And you can sell that to say JP Morgan, Morgan Stanley, or say LIC. Even LIC trades a lot because they're insurance, right? So the premiums that you pay them, they invest in the market, they try to make money with that, and then when you say have an accident, then they have to pay you premiums. So that comes from the market. So they have to trade in the market quite actively and make a lot of money from the market. So you can sell this to them. Okay. Now in conclusion, to just like sum up everything that I've spoken about, quant finance is like a multidisciplinary field. You need stats, you need maths, you need a lot of computer science, coding, Python, data analysis, SQL, stuff like that. And you also need financial knowledge. Okay. You need to know a bit about industries and how stuff works and like things like that. Okay. And this field basically is going to evolve a lot in the future, because with AI catching up, the mathematical models that you can build using say ChatGPT, using Bard, using some other cool AIs with so much processing power is going to be very interesting. Okay. And going forward, we might also reach a stage where you don't lose any money in the stock market. Okay. This is very hypothetical, but like anything can happen in this field. Okay. We didn't know anything about AI until like ChatGPT came out. We also don't know much about quant finance until like a new AI quant finance thing comes up. And when that day comes, it's going to be very interesting for everyone involved, and I'm waiting for that day. Okay. So thank you for watching. I hope you understood more about quant finance, because having a basic introductory knowledge about this field is quite important. It might evolve a lot, but this knowledge is going to help you in some way so that you're aware of what's happening. So thank you for watching. I hope I added value. See you later.